Good afternoon, everyone. It's Garth Mackenzie here coming to you from the UK. So today's session number 2. And what we looked at last week was playing in the right sectors, relative strength analysis and relative sector strength. We did that, so hence it's got a little tick. What we're looking at this week is the second part, which is seeking high probability chart patterns. And then obviously, in the remaining 3 weeks after this, we're going to look at money management and risk management next week. That's always a topic that I enjoy presenting because I think that's really where the success or failure comes from as a trader. Actually, putting it all together will be in the 4th session and building a trading playbook. And then the last session, we'll wrap it up and put it in a box, and a box trading method, which is something I try and encourage people to do, to try and stick to the principles that I'm teaching you on each of these sessions. So for today's webinar, this is seeking high probability chart patterns and breaking it down into subsections. We're going to be identifying support and resistance levels. We're going to look at continuation patterns, and we're going to look at false breaks. I have got quite a lot of slides to get through, and we've only got an hour, so I'm going to make the pace of this relatively quick. If you have got questions, you've got a Q&A box on your Zoom platform there that you can post questions into, and I'll get onto those questions at the end. What I would ask, if you don't mind, is to try and keep the questions relevant to the subject that we're talking about today, because as I say, I think I'm going to be under time pressure to finish the presentation as it is, and then I would like to get through the questions at the end, but try and keep them as relevant to the topic of discussion today as possible, please. All right, so let's go straight into it. Support and resistance levels. What are they? What do they look like? We're going to start talking about uptrend support. With each of these slides, you'll notice that I've created a little sort of a theoretical diagram with each of them, and then the key concepts to be aware of on the right-hand side here. So that's a very basic diagram of what an uptrend would look like. There's your share price climbing, consolidating, making higher lows, pulling back to trend. The key to a rising trend, or to what we need to see for an uptrend to be valid, is for the price to touch the trend line at least 3 times or more. And the more times it touches that trend line, the more valid that trend is. All right. So those are the key concepts on the right-hand side. As I said, there are 3 or more points must touch. The more points that touch, the better. Watch for evidence of buying or a reversal at the uptrend if buying. And I'll talk to that point a little bit more in a second when I show you an actual slide or an actual price chart of a rising trend. And then this one you've probably heard before: the trend is your friend. It's an old saying in the markets. Some say the trend is your friend till the bend at the end. And that's also fair enough as well. The key is that the trend really is your friend. You want to be aligned with the direction of the trend until such time as the trend proves that it's no longer valid anymore. And you'd be surprised, trending moves can often last longer and run on longer than what you might expect. So don't fight the trend. You know, I've seen it in my career so many times with amateur traders. They come along and they see something that's up a lot, and they think, oh, well, it's gone up so much, it's surely going to come down, therefore I'm going to short it. But you're fighting the trend. You want to try and align your trading with the direction of the momentum, align it with the direction of the flow. So if the trend is rising, that's where you want to be a buyer. You want to be getting on board that trend. All right. So here's an example. This is probably right now one of the most topical and best examples of a rising trend that we've seen all year. This is the US dollar index. All right, so it's not a stock per se, it's an index of the US dollar against a basket of other developed market currencies. But for our purposes here, it's quite useful as an illustration graph. So you can see that that rising trend is very neatly joining all of those low points on the chart. Right? Each time it's pulled back, it's found support. And it just also so happens that that support line is more or less coincided with the 50-day moving average as well. So every time the price is pulled back into support and into the 50-day moving average, it's rallied back up. Now, I say it's topical at the moment because it actually looks right now as if it's starting to break that trend. And particularly today, after we've just had the US CPI data came out a bit lighter than expected, that's got the markets all excited, and the US dollar index is trading weaker on the back of that. So maybe we're now starting to see the part where we get to the trend is your friend till the bend at the end. We might actually be seeing the bend at the end right now on the US dollar index. But I digress. What I really want to point out here is the fact that the price has held that support on each successive pullback up until now. Now, the question I'd ask you is, why do you think that happens, right? Is it a coincidence that the price got there and then it rallied? Or the price got there and rallied? You know, why did it not go lower? Why did it not stop at a slightly higher point? Why did it go exactly to that point? And at that point, it then rallied. And again, more recently, in the end of October, it got exactly to that trend line and rallied. Well, the answer to the question is that technical analysis works because people practice it. So I'm not the only guy drawing that trend line on the chart. There are thousands, millions even, of other traders out there in the world who are drawing the same line on the chart, and they see the same thing that I do. So when the price gets there, they all look at it and say, wow, that's support, worked in the past, probably going to work again. I'll be a buyer at that level. And if it doesn't hold, well, then I'll exit. And of course, if enough of us all collectively do that, then what it means is that the collective mass of participants in the market end up supporting the price and push it higher. All right. So that's the background to why a rising trend works, and why they often will trend for longer than what you might expect. And always think about that with a chart. Try and remember that a chart is a graphical representation of the dynamic between buyers and sellers in the market. That's all it is. And look at the chart and read it and say, well, what is this telling me about how the buyers are seeing the market? And what is it telling me about how the sellers are seeing the market? That'll give you a clue as to what you might expect from the price action going forward. Right. So then the opposite of a rising trend is a downtrend. And it's exactly what we've just seen, except it's all flipped on its head. So now instead of the price rising, you've now got a price that's steadily declining. And again, you'll notice that the key points are much the same. Your trend line must join 3 or more high points in this case on a chart. So each time it rallies, those high points need to join and be joined by a straight trend line. The more points that touch, the more entrenched the trend, same as before. Watch for evidence of selling or a reversal at the downtrend if looking to sell short. And if you were looking to sell short off of a move off the downtrend in an example like this, then what you'd want to do is put a stop loss just on the other side of the trend line. In other words, if the trend breaks, then you don't want to be in that trade any longer, then you'd execute a stop loss. But as long as the trend is intact, then the trend is your friend. So if we look at an example, the gold price this year has been a good example of a downward trend. And again, it's another one that actually looks to be breaking today or this week. We've got gold right as I speak to you trading up at about 1740. So it's made a nice move higher. And that's also on the back of that weakening US dollar that I spoke about a moment ago. But again, I digress. What I really want to stress here is the fact that this downward trend is very much, well, it has been very much intact up until now. And the same question I asked as previously, why did the price get to that level and stop dead at that trend line before it moved lower? Same the previous time, right? The reason is because collectively, there's a lot of people watching this chart. They're all seeing the same thing. They all see that, oh, well, there's downtrend resistance. It's failed there before, probably going to fail again. Therefore, I'm going to go short at that level. Or if I'm holding gold in this case, that might be the area where I look to sell it. And that's, again, why these trends can continue for longer than what one might expect. It also adds, the question, I suppose, like now, when you begin to see a trend break like that, that means that the collective psychology of the market has now started to shift. There's no longer sellers that are dominant at that downtrend. The sellers are now being overpowered by buyers, and that's what's driving the price up above the trend line. So, that in itself is now reason not to be bearish anymore on gold. The fact that it's broken above the downtrend implies that the sellers are no longer the dominant force here. And it looks as if there's a dynamic shift taking place where the buyers are now becoming the stronger force in the market. All right. Then I'm going to look at horizontal levels of support and resistance. And the theoretical diagram here explains it. Effectively, if you've got a price that's trading along it, it'll often find a bit of a range and an area where there's what we can call price memory. So price memory is where, for example, it gets to a level, it struggles to go any higher, so it pulls back, and then it buyers step in, it finds support, lifts the price back up. Now, when it gets back to that previous high price, there's market memory there. A lot of market participants might look at it and say, well, the last time it got there, I wanted to sell and I didn't, and now I feel like a silly fool for not selling when it pulled back. It's got there again. I'm going to now take my opportunity to sell. And that sort of psychology is what creates these resistance levels. And you get these ranges that play out. And likewise, at the bottom end, if a price gets down to support, like there, for example, perhaps you got somebody who says, well, the previous time the price got down to that low level, it looked cheap, but I didn't buy it. And maybe it's got there again. Perhaps I better take my opportunity this time. That's the type of psychology that is in play for these things. What's important to note here is that when a price breaks out above a resistance level, as is illustrated here, what often happens is you get what's called polarity. So where what was previously resistance now becomes support. So the price breaks out through the resistance. And now when it pulls back, it finds support. Buyers step in at that level and hold the price above. So what was previously resistance becomes support. And you can see this happen over and over again. Now, in terms of the key concepts to note here, as I said, flat lines that join at least two or more low points or high points if you're drawing a resistance line. The more points that touch, the more significant that level of either support or resistance is. You want to be watching for evidence of buying or a reversal at the horizontal support if looking to buy. So if, for example, you've now seen that the price broke out, it's pulled back, it's now at that level of support, which was prior resistance. Now I want to start watching for a reversal, for evidence of other buyers coming in at that level. And that's where I would look to be a buyer. Okay. And a stop loss below a reversal low, or if the price starts to trade back underneath that trend line again. Horizontal support is an area of price memory, which is what I mentioned before. And then prior resistance becomes support when resistance is broken. As I said, that's called polarity. Now, if we have a look at an example of it, here's a chart of Netflix, and we're going to actually visit this chart twice this evening because there's something else interesting, which I'll talk to you about on it later. But here you've got this example of the price action ping-ponging between the support and resistance levels. Up here at $250 a share, that's been resistance for the last 3 months or so. Each time the price got up there, it struggled to go any higher. And then when it pulled back, it was finding support at around $220. Eventually, it actually gapped up. This was on earnings during October, gapped up through that resistance. Now we're at this point where it's pulling back, and it's like we're going to probably see that polarity that I referred to. What was previously what was previously resistance at $250 now becomes support. And I'd bet relatively good money that Netflix holds that support now at 250 and bounces off that support level and starts to make a move higher from here. So that's the example of where that previous resistance now becomes a support level. The opposite now is just in the sort of the more declining type of situation where what was previously support in this case now becomes resistance. So when you've got the price ping-ponging between a support and a resistance level here, it breaks down below the support. That support level will now become resistance into a rally on the way back up. So if price rallies and gets there, likelihood is that it's going to find some resistance and some selling pressure where the previous support was. So in terms of key concepts here, again, flat line must join two or more points of equal price in terms of horizontal support or resistance. The more points that touch, the more significant that level of resistance will be. Again, watch for evidence of selling or a reversal at that horizontal resistance level to go short. I see there's a question about going short, so I'll answer that in a moment. Stop loss will be if the price goes above that, back above that resistance level. If it breaks back above there, then you need to concede that maybe the buyers have stepped up and they're getting stronger. You don't then want to be short in that case. Again, these horizontal levels are an area of price memory, and previous support becomes resistance when it fails. Okay. Now, someone asked the question here, Mike, you've asked, what's the definition of short selling? So it's a good question. Short selling is where you take a view that the market or the price of a share is going to go lower. So typically, we're always taught that you want to buy something and sell it at a higher price. And that makes sense. In the stock market, in the financial markets in general, you can do the opposite. You can actually sell first and then buy back at a lower price. And the difference is your profit. Now, it's the same thing. It's just that the timing and the buy and the sell is switched around, and it's perfectly legitimate to do that. There's a complex hedging process that goes on in the background with borrowing script and all that in terms of how you borrow shares to sell short. I'm not going to go into the minutiae of it because we don't have time. But in essence, to answer your question, Mike, selling short is where you're basically wanting to profit from a move down in a share's price or in the movement of the market. So here we have an example of this resistance at the moment on Kraft Heinz. That's the food business, tomato sauce, amongst many other things, business listed in the USA. And you can see how this level of $39 has acted as resistance. So there's a lot of price memory at that level. Notice how each time it's pushed up there, it's failed. And it recently went there again and it's failed again. My sense is that eventually this will keep pushing up, and eventually it'll probably break above $39. And that will then be bullish. And you'd then find that instead of that $39 being resistance, as is the case now, it would become a support level. Right, then we're going to get into continuation patterns. But before I do that, I'm going to take a quick sip of my coffee just to clear my throat as well. All right, there we go. Continuation patterns are consolidations that happen within a trend. So they can be in a rising trend or a declining trend. We're going to look at both. There are various different types of continuation patterns, but what I like about these continuation patterns is that the way we trade them is we try and get on board the broader momentum of the market by waiting for one of these continuation patterns to form. So it's almost like the price moves in a direction, then it pauses and kind of catches its breath. And whilst it's in that catching its breath, pausing phase, that's the time that you get the opportunity to set up a trade and to actually try and get on board for a move in the direction of the prevailing trend. They generally are quite high probability setups. When I say high probability, I mean they work more than half the time. With many of these setups, you can find they can work 60-65% of the time, which is good. That's 2 out of 3 times. That's a pretty good hit rate. All right, so we'll go through each of them one by one. The first here is triangle patterns. A bullish triangle specifically is what we're talking about here. So you can see it illustrated on the left-hand side there. The price comes into a triangle pattern from the bottom left. In other words, the trend is already rising when you see this begin to fall. So it's in a strong upward trend. Then the price starts to consolidate and catch its breath. Typically, there are 5 waves in a triangle pattern, and you can see them labeled over there. 1, 2, 3, 4, and then 5th wave is usually the one that breaks out. A couple of important things to note about a triangle in terms of the size and the length of the pattern. Usually you want to see that price break out on the 5th wave and also around about 2/3 of the way into the apex of the triangle. So if you had to draw your triangle boundaries on either side of this pattern, pull the lines all the way out to the end, and you'll notice your apex point over there. Now, typically your breakout should happen around about 2/3 of the way into the apex, and it should also happen on the 5th wave inside that triangle. If you get a triangle where it continues to compress into the end of that apex, often those ones don't work out in my experience. You actually want it to break out on the 5th wave and move. If it starts to consolidate and press into the end of the apex, often it actually might either just keep dribbling sideways, or it might break down and go the other way. There's a book by a guy called Thomas Bulkowski called Getting Started in Chart Patterns. And he's obviously had plenty of time on his hands at some stage, and he went back and analyzed all of these patterns in various different instruments: stocks, bonds, commodities, indices, currencies, you name it, thousands of charts. And he tried to basically build up the track record of each of these patterns to look at it and see, well, you know, how successful is a triangle pattern? How successful is a head and shoulders pattern? How successful is a wedge pattern, for example? And he came out that a triangle pattern is quite a high probability pattern. And he observed that it generally breaks out and goes on to meet its target in about 66% of cases. So about 2/3 of the time. So it is a high probability trading pattern. Now, the way you trade it is you buy on the breakout through the top of that pattern on the 5th wave as it begins to occur. And then you set a stop loss below the bottom of the 4th wave, which is the bottom of that triangle pattern over there. And your target you can obtain by taking the height of that triangle structure at its broadest point, where wave number 1 forms, and you can then take that distance and project it up to a measured target. And the difference of risk and reward there is illustrated. You can see the risk is basically the difference between where you enter this trade and where your stop loss would take you out. And the target, the difference between the target and the buy point is your reward. And typically speaking, you should be able to get a risk to reward ratio of 2 or 3 to 1, if not better, on a triangle pattern. And keep in mind that the measured target is, you know, it's not to say that it stops there and that's the end. Sometimes it goes beyond that, but that's a minimum measured target that we're talking about. Right. I think I've covered all of the key concepts. Let's have a look at an example. So this is ExxonMobil. Now, this is actually an hourly chart. You can see indicated there at 60 minutes. I went and looked at this one on a shorter time frame, really, because I thought it was quite a good example. You'll recall that last week we spoke about relative sector strength, and we spoke about the energy stocks being strong. So, you know, if you think about this in the context of that, we're now talking about an energy stock that is strong. It's in a strong sector of the market already. It's clearly got upward momentum on its side. This triangle pattern starts, it enters from the bottom left of the chart, and then it consolidates quite clearly into those 4 or 5 different wave structures, and it breaks out on the 5th wave. And notice also, if you stretch the apex points out, yeah, roughly speaking, that breakout occurred on approximately 2/3 of the way into the apex. So if you were trading this, you would have bought on that break above $102.50 there, and we used a stop loss down below the bottom of that wave 4, which was about just under $100, call it $99. All right, so quite a nice risk to reward ratio with a relatively tight stop loss here. And the key thing also is, notice here, we're not fighting the trend. The trend is up. So we know the momentum is up. We know the direction of travel is upwards. We're simply identifying a high probability time to get in and buy, and then we've managed our risk by putting a stop loss in a very strategic place. Okay, so high probability trade because all the factors are pointing in the right direction for us. You're not trying to fight the momentum. You're not trying to, you know, get in the way of something. You're actually trying to swim with the flow of the current, if you will. And that's important with trading in general. All right, then triangle patterns work both ways. As I said, all of these continuation patterns we'll look at, you look at both the bullish case and the bearish case. So they do also form in downward trends as well. Everything's the same. It's just all flipped around. So again, this time it comes in from the top left of the chart. So in other words, it's coming from a weakening perspective, trades into 5 waves with those clear boundaries demarcating the edge of the triangle pattern. The fifth wave is where you want to see the break to the downside, and that should happen roughly 2/3 of the way into the apex of the triangle structure. And again, to get your target, you take the height of the triangle at its broadest point and measure from where the breakdown occurs, project it down, and that'll give you your target. And again, you can work out your risk to reward ratio by looking at your risk being the point from where you shorted the stock, and then your stop loss will be above the top of that wave 4 in the triangle structure, and your target is down there as measured, like I said. So you should again be able to get a risk to reward ratio of 2-to-1, 3-to-1, that sort of thing on a triangle pattern like this. And these work well. I mean, when I see a triangle pattern setting up, I generally always trade it. They don't always work. Like I said, nothing in this game is ever 100% foolproof. But that's why we have risk management, which we'll talk about next week, because sometimes trades don't work out, and it's keeping the losses small that is really critical. But before that, we want to identify high probability patterns to get into. And that's what I'm talking to you about here now. So here's an example of a bearish triangle pattern, and this is the Spider Bank ETF. Okay, I actually struggled a little bit to find a nice example of this, but for some reason, I don't know why, I couldn't just scan a lot of charts and I didn't find too many bearish triangles to talk about. But here's one that I felt was worth mentioning. So there you've got it, comes in from the top left, trades into those 5 or 4 waves. It breaks down on the 5th wave and then heads lower. So if you were shorting this, you would have shorted the breakdown below the bottom of that triangle structure with a stop loss above point number 4 over there, which would have been the upper end of that triangle structure. Right, so that's a bearish triangle. Then let's move on to flag patterns. So we're going to talk now about bull flags and bear flags. So a bull flag, as the name suggests, is bullish, and it happens within a rising trend. And it's again an example of a consolidation where the price stops, pauses, catches its breath before it then makes another move, generally speaking, in the direction of the trend, hence the name, a continuation pattern. So a couple of things to note. A price of a bull flag enters from the bottom left and consolidates into the flag structure. The boundaries of your flag pattern are parallel to one another. Okay, that's quite important. Time frame, it's variable. I prefer flags that form on the daily chart to break out in under a month, and that's been the same for most of these continuation patterns that I'm talking to you about. Same for triangles, same for flags, and all of these things that we're talking about now. It doesn't have to be a hard and fast rule. Sometimes a flag can take longer to form. Sometimes it can take a lot quicker. I mean, these things are valid on all the different time frames of charts. So whether you're looking at daily charts or weekly or intraday charts even, the principles are the same. I just find that in my experience, when I'm looking for these continuation patterns to validate, they're quite reliable if they actually can make the move and do the breakout inside of sort of 4 to 6 weeks, let's say. If they start dragging out a lot longer than that, then I find they become slightly less reliable and might morph into other patterns potentially. Right, measured target for a flag is taken by measuring the height of what we call the flag pole. So you'd look for a sort of an obvious low to an obvious high before the flag pattern formed. And then you'd take that distance and measure it from the bottom of where the flag pattern starts to where the bottom of the flag pattern is evident, and measure that up to get your measured target. And the way you trade it is you'd buy a break through the top of that flag structure. Your stop loss will be down below the bottom of the lowest point in the flag, and then you'd look for a move up to your projected target. With flag patterns, the risk to reward ratio varies, depends on how it's setting up, but you should most of the time be able to get a 2-to-1 risk to reward ratio on a bull flag pattern. And again, it's a high probability pattern because you're buying something in the direction of the momentum. So you're getting on board with that rising momentum and looking to be a part of it. You're not trying to fight the momentum. So as an example, here's a nice example with McDonald's recently. There's your flag pattern quite clearly indicated by the parallel lines over there. And when it started to break to the upper end of that flag structure, that would have been your buy signal. Stop loss would then be below the lowest point of that flag before the breakout occurred. And then you'd measure your upside target by taking the height of that flagpole that I'm indicating there to get a target. I think in this case, it would have pretty much met the target, or if not, it got very close before it started to consolidate and come back a bit. So that's an example of a bull flag in practice. Right, bear flags are just the opposite, all flipped around again. So your price comes in from the top left and then it consolidates into the flag. Again, your boundaries of the flag pattern are parallel, right? And your time frame again is variable, but I prefer them to form in under a month. Measured target, again, taken by looking at the length of that flag pole before the price entered this flag consolidation pattern, and then measuring that distance from the top of the flag structure out and down to the bottom. That'll give you a measured target. And the idea here in terms of trading strategy is you would look to short a break down below the bottom of that flag, and your stop loss will be above the highest point in that flag pattern before the breakdown occurred. And then you get your measured target, like I said, from the flagpole projecting. All right. And again, risk to reward ratio, I've explained to you, so I don't think I need to go into too much more depth about that. Risk, simply the difference between where you enter the trade and where your stop loss would take you out. Reward is the difference between your entry point and where your target is. So here's some examples on Johnson & Johnson recently. Again, notice the trend was down at the time, right? And the price consolidates into these bear flag patterns. So it's like a pause within the overall downward trend. You can see it's below all the moving averages. All the moving averages are pointing south, right? So the idea here being that when the price breaks down below the bottom of that bear flag structure, that's the time to sell short, and you'd put a stop loss above the highest point of that flag before the break to the downside occurred. And there are two examples in succession over there of this that worked out quite nicely. And again, like I said, flags are quite a high probability pattern. They'll work more than 50% of the time, generally speaking, because of the fact that you're aligned with the overall momentum of the market. Right, now we're going to talk about wedges. So falling wedges and rising wedges. Now, a falling wedge is a bullish pattern in a rising market. So I know it perhaps gets a bit confusing because we're saying it's a falling wedge, but it's a rising market. Well, here's the reason, right? Your price comes into the pattern from the bottom left, starts to consolidate into this flag, into this wedge rather. Now, the key difference here between this and a flag pattern is that with your wedge, the boundaries of the structure actually taper in towards one another. They narrow in towards each other. Whereas with the flag, remember, the boundaries were parallel. The time frame is variable. Again, I prefer wedges that form on a daily chart to form and break out within a month. Now, in terms of getting a target here, usually what you would look for is for the price to break to the upper end of the wedge, in this case, in a falling wedge in a rising trend, break to the upper end, and you'd look for the price to go back and retest the previous high point from when that wedge began to form. And that's a minimum target. It doesn't mean it has to stop there. It can often go beyond, right? But that's the minimum target that we generally look for. Because of the way these things are structured, you actually find you get quite good risk to reward ratio on a falling wedge. Usually the reason for that is because your stop loss can be quite tight. So you buy on a break above the upper end of that falling wedge, looking for that target to go back to the prior high, and your stop loss is the lowest point before the break to the upside occurred. And that is usually a fairly tight stop loss, which enables you to have quite a generous risk to reward ratio on a falling wedge. Right, so let's have a look at this in a practical example. So I've got two over here on PepsiCo. So this one back in July is quite a nice example how that wedge pattern formed again within the overall rising trend. When the price began to break to the upper end of that wedge pattern, that was your buy signal. and you would have set a stop loss then just underneath the lowest point of that wedge pattern before the breakout occurred. And in this case, it went to the target and quite a lot beyond. Okay. Now, I've drawn a second one in over here, which is valid, but this one took longer to form. It took 2 months for that falling wedge to form on PepsiCo there. But nevertheless, it is valid. And you can see that it's working. And the price broke to the upper end of that wedge, and it's moved on to the target. So it has worked. But as I say, ideally, in my experience, I quite like it when they're like that one in July, where they form over a fairly short time frame and they break out and they make that move quite quickly. Having to wait for one like this to form, it can quite easily morph into all sorts of different things. You could probably argue there's like a head and shoulders there, and how valid is this? But I put it in just for illustrative purposes. Personally, I prefer these wedge structures to form over a month or less. All right, then the opposite of this is the rising wedge. So this is a bearish pattern, forms in a declining trend, but the direction of the wedge is actually pointing to the upside. So again, the key concepts, it enters from the top left. The wedge boundaries narrow in towards one another. They taper towards each other. The time frame, variable, but I like them to form under a month, ideally. The wedge target is a move back down to retest the prior low before that, from the bottom of where that wedge pattern began to form. And here you'd again short a break down below the bottom of the wedge structure, looking for a move down to test the prior low, and your stop loss would be a break then above the highest point of that wedge before it broke to the downside. And again, that'll give you quite a nice, good risk to reward ratio if you're trading these. So here's a recent example of one currently in play right now. It's a trade that we put out for some of our Traders Corner subscribers a few weeks ago, and this is on Southern Company. There you can see the rising wedge pattern forming quite clearly. It's in an overall downward trend. The price breaks down below the bottom of that wedge, and again, notice the moving averages are all pointing downwards as well. So the momentum is down. We're just getting on board with that momentum. So you'd short the break out the bottom of the wedge structure, and your stop loss will be above the highest point of that wedge before the break to the downside occurred. And in this instance, we'd be looking for the price to move back down and retest that prior low from where the wedge pattern began to form. Okay, then false breaks. So we've discussed all the continuation patterns now. We talked about triangles, flags, and wedges. Those were your 3 continuation patterns we talked about. Before that, we talked about just good old vanilla support and resistance levels. Now, the thing is that in the market, these patterns aren't always as clear-cut as the way I've made them look here. And obviously, I've gone and I've cherry-picked examples of where it's worked, to the textbook. But the truth of the market is that they don't always form this way. It's not always as simple as this. Sometimes you've also got to understand that you might get false breaks. And how do you trade a false break? So I've got 2 examples to show you here in terms of the concept around a false break. But I mean, false breaks can happen in various different forms. You can get false breaks out of all of these continuation patterns that we've just discussed. You get a false break out of a triangle or a false break out of a flag, right? For the purposes of this illustration, I'm just going to show you like a range, a trading range, which makes a false break in one direction. So here we've got an example of a bullish false break setup. The price has been bumping along up and down within a range. It then starts to break down below the bottom of that range. And you'd ordinarily think, okay, well, that's bearish because it's now taken out all those previous lows from the recent past. And all of these people that have bought and traded the stock in that area are now losing money. So there's probably going to be follow through to the downside with more selling pressure to come. And then what happens is it doesn't follow through to the downside. Instead, buyers step in and lift the price back up into the range. Now, that is a false break. And what has to happen for that to occur is that yes, the price has to break to the downside, but the buyers have to come along and be very strong in order to overpower the sellers to push that price back up into the trading range. And the fact that the buyers have got the strength to do that and to overpower those sellers when the sellers should have actually been quite strong on the break to the downside, that's a big clue that your buyers are actually quite strong and they've got the upper hand. And that's where this saying, from failed moves come fast moves in the opposite direction, comes from. It's interesting how often this is the case. So remember that from failed moves come fast moves in the opposite direction. So in an example like this, where you get a failed move out of one side of the trading range, and then that doesn't follow through and it gets back up into the range, very often what you'll then see is the price will actually then break out ultimately out the other end of the range. And that's where one could look to try and trade these false breaks. So the way you would do it is, if you see a false break to the downside like that, price goes back up into the range. Once it's back up in the range, then you've got a fairly high level of confidence that the buyers actually are quite strong. And at that point, you can then look to buy, and you use the lowest point where the false break got down to as a stop loss. Okay. What happens here from a buyers and sellers dynamic perspective? Well, yeah, what might have happened on the break to the downside is a whole lot of stop losses might have triggered when all of these prior lows were taken out. A whole lot of stop losses would have triggered. So that's what perhaps forced the break to the downside. But there's no continuation selling. There's no follow through selling. So it's telling you that the buyers are stronger. Price gets back up into that trading range. And that's when you can either get some short covering that can push the price higher, or some natural buying. But by and large, once you've seen that false break to the downside, it's quite common to actually see that buyers come along and push the price up, and become the stronger force. Right. So an example is Netflix. Right. I said to you we were going to come back and revisit this chart of Netflix later in the presentation. So here we are. Again, notice the price ping-ponged up and down between this support and resistance area. So $220 was support, resistance was at 250. It did break down below 220 briefly in October, but notice how quickly the price rallied back up into the range. Now, what that is telling you is that the buyers obviously are strong here, because it was not allowed to follow through to the downside once it broke down below support. Instead, the price moved higher. Buyers were strong. And what did we get quite shortly thereafter? Well, we got earnings, which came out, which were very, well, better than the market expected. And the price gapped higher and gapped right up through the upper end of that trading range. But that false break over there was actually the clue telling you that the buyers here are strong. So be aware that this thing could actually break to the upside. And that's exactly what we got. Okay. So that's a false break, and they're not always that easy to spot if you don't have an experienced eye for reading charts. But if you do spot them and you see them, they are quite high probability trading opportunities when they occur. And not only are they high probability opportunities, they also generally give you quite a good risk to reward ratio when they're set up, because you can have a fairly tight stop loss, but with potentially quite a lot of upside when the price breaks in the opposite direction, because that move in the opposite direction is often kind of a surprise where everybody suddenly finds themselves either having to cover shorts or having to chase the stock higher to buy it. So you kind of get a big wave of buying pressure that pushes that price higher. Then on the opposite end here, this is a false break to the downside, or a bearish false break. So here again, you've got your price trading in a range, ping-ponging up and down. It breaks to the upper end of that range, but it is unable to follow through to the upside. Instead, it comes down, back down into the range. Now, once that happens, then that's also a clue that the buyers simply were not strong enough to take that price any further once it broke out the top of the range. And that's when you then get an indication that the sellers are actually the stronger force here. And again, from failed moves come fast moves in the opposite direction. I've seen this many times where you get a false break to the top of a range, can't follow through, comes back into the range and ends up breaking down out the bottom end. Okay, so the way you would trade that is you would short sell once the price gets back down into the bottom of, or back into the range. That's when you'd enter your short position, stop loss above the highest point of that false break, and you'd then be looking for a potential move to the bottom of the range and potentially actually a break to the other end of that trading range. And again, you can get fairly decent risk to reward ratios on these setups when they occur. So an interesting example of it recently here was on Tesla. The stock had been, look, it had been fairly weak anyway, but it then started to ping pong in a range here between about $205 and up to $230, up and down, up and down. It then made an attempt to break up above 230, and ordinarily that should have been a bullish break, but it didn't follow through. You know, on the same day, the sellers came along and they overpowered the buyers and pushed that price back down into the range. And that then was a clue that the price of Tesla didn't have the momentum, didn't have the buying support behind it to enable a break to the upside to follow through. And the sellers were, at that stage, there was an indication that the sellers were quite strong. And as you can see, the price then broke to the downside, and we got that situation again where from failed moves come fast moves in the opposite direction. All right, so that's it in terms of the presentation, in terms of my slides. I see I've done it in 45 minutes, so that's not too bad. It leaves us with 15 minutes for questions and answers. I'm just going to put that disclaimer there for you if you feel like reading that and you've got very good eyesight that you can read that small writing. And what I will do now is have one more sip of my coffee, which is pretty cold by now, but nevertheless, it's going to lubricate my throat, and that'll give me an opportunity to then get into all of the questions. I see there are 8 questions open at the moment, so I'll try and get through each of those. And if you do have any questions that you'd like me to answer before we finish, then now's your opportunity to pop them into the questions box. That is definitely cold. Okay. Jeff Gibson, you've asked what sort of time period for a continuous triangle. Okay, so I think I answered it. I prefer them to be less than a month, ideally, but they don't have to be. They can sometimes be longer. It's just in my experience, and perhaps it's for my style of trading, I find that a triangle that forms inside of a month generally gives me a result fairly quickly. That's the one thing. And also, it's then unlikely to morph into some other type of trading pattern. So yeah, the answer there is less than a month. That's my preference, but it's not the textbook answer. It can actually be longer. Then another Garth Lubbers, you've asked, is there an ideal time scale to use when identifying trends? So all of this analysis will work on different time frames. So whether you're looking at weekly charts that go back many years, or daily charts that go back many months, or hourly charts that maybe only go back a couple of days, the concept is the same. The principle is the same. So you don't have to be totally strict in terms of the time frame that you're using. The analysis, all of this analysis is valid on various different times, be it longer term charts or shorter term charts. Okay. I think one thing just to bear in mind when talking of trends, because that's the question you've asked, is that the longer the trend is in place, the stronger that trend is. If a trend line that's been in place for many months is typically a lot more reliable than a trend line that's only been in place for a couple of days. Okay, so just keep that in mind. All right, and then Mike, you asked, may you ask whose trading platform I'm using for this presentation? Okay, so I've used stockcharts.com for the charts that I've presented here. Bear in mind, this is a PowerPoint presentation, so I'm actually not on any trading platform when I present this. I just screenshotted some graphs off of stockcharts.com. That's what I use personally for my offshore charting. I understand from Rand Swiss that they give you access to Velocity Trade and to DMA, and those platforms both have charting facilities embedded into them. So yeah, you should be able to do all of this analysis that I've shown you here on those platforms, both on Velocity Trade or on DMA, if you're trading on one of those two platforms. Generally speaking, nowadays, all trading platforms have charting embedded in them. So you can do this type of basic charting like I've done here using your trading platform. Okay, then Anonymous, who's asked, what's your split in terms of processing information between technical analysis and fundamental analysis? Oh, that's a good question. So my answer to that is that by and large, I am guided by the technicals for my trading. I'd say 80%, 85 even, 85% technical analysis driven. But that's not to say that I'll ignore the fundamentals. It's just that my thinking or my reasoning for saying that is that a chart typically is a representation of all the fundamental information that is currently known by the market at any given time. So you almost, if you're reading the price action, you're accounting for a lot of the fundamentals anyway. And I'm talking specifically about trading now, short-term trading. I'm not talking about long-term investing. That's a different story. So yes, I keep abreast of the fundamentals. I like to know what's going on fundamentally. Now, I do a lot of fundamental reading. But from a trading perspective, you'll find that in the short term, stock prices don't always adhere to the fundamentals. You can have a stock that's cheap, and yet the price is going down. And, you know, then you've got a discrepancy between your fundamental valuation being cheap and your technical analysis, which is saying, well, but the price is still going down. You know, so do I want to be buying it? Even though it's cheap, maybe I don't want to buy it if it's still going down. Maybe it's cheap for a reason. Okay. So from a short-term trading perspective, I lean a lot more towards the technicals than what I do towards the fundamentals. All right. Then Graham Sturley. Hi, Graham, a long-time client of mine. Do you find retests of pattern breakouts are becoming frequent? So Graham, yeah, it's a good question. Sometimes they do, sometimes they don't. I've seen, in fact, a guy that I know you also follow, Graham, is a guy called Julian Komar in Germany. Good trader, tweets a lot of very interesting stuff. And he lives by the philosophy that if you get a breakout, you don't want a retest of that breakout. You want a consolidation that happens higher up above the breakout level, but you don't actually get a full retest. And if that's the case, it is indicative that there's strong buying pressure behind the price and that it wasn't able to do a full retest. So, and it's not a hard and fast rule around that. Often you will get a retest of a breakout, but not always. And I think the key is when you do get a retest of a breakout, watch that the support level holds. And I'm talking obviously a bullish breakout now. You want to wait for evidence that the support of that breakout area holds before starting to get involved. Anonymous, you've asked, what is short covering? Okay, so short covering, I explained earlier what short selling is, where you basically sell something in the expectation that the price is going to go lower, and then you hope to buy it back at a lower price. And the difference between your sell price and your lower buy price is your profit. Now, short covering is where the shorts start to buy back their positions. So what quite often can happen is if you get a situation where there's a lot of short interest in a stock, and maybe the price is not going down the way the short sellers would have liked it to. Instead, the price is going up. Now they're losing money because the price is going higher and they're short. The more money they lose, the more nervous, the more jumpy they get, and the more likely they are to then try and buy back the short. And a short squeeze or aggressive short covering is where you get lots and lots of shorts buying back the stock. And it forces the price to go higher. That's what short covering is. All right. And then Anonymous again, you asked, hi Garth, trading a CFD equity short on MetaTrader on GT247, okay, competing broker. The price fell below the take profit level at the market opening, but did not trigger because the platform only opens at 9:10. By the time the platform opened, the price had recovered. I assume stop loss will also not trigger in these circumstances. Yeah, so that would be, I mean, I can't speak for GT247, and I probably shouldn't. It's not their platform that we're on right now. This is a Rand Swiss presentation. But I do know that I think what they offer is an over-the-counter CFD service. So yeah, if they're not available to trade in those first minutes between 9 and 9:10, it's not ideal. And can you do something about it? I mean, you could possibly use a different broker, trade through a platform that's got direct market access so that you're able to trade in those first 10 minutes and that you're not disadvantaged by those kind of rules. That's probably an example, an explanation. But like I say, they're not here to defend themselves, and this is not their webinar anyway. So I'm going to just skip over that from here, if you don't mind. What's the best book to learn more? Or is this online course better? And that's Ray's question. So there's lots of very good books on technical analysis. Anything by Martin Pring is generally quite good in terms of understanding the basics of technical analysis. On my online course, I go into the technicals in greater detail than what I'm doing here, because as I said, this course is just the light version. There's 8 hours of video content on my online course, and there's assessments and there's resources and all sorts of things. So you'd get a greater depth of understanding of the technicals from that. If you wanted to, it'll help. But yeah, I mean, in terms of books, anything by Martin Pring is probably good as a starting point to understand technical analysis. There are a lot of other books as well, but those ones are good. Okay, then Herb, you said there was an RSI on the charts. Is it used as along with the expected trend movements or breakouts? Does RSI add to a high probability setup? So the RSI is a momentum indicator. It measures overbought and oversold, and it measures the strength of a trend in one direction or the other as well. What I like to look at on a relative strength index, RSI, is for the RSI reading to be above 50 in a rising trend. Now, keep in mind your RSI, relative strength index, ranges between 0 and 100. It can never be less than 0. It can never be more than 100. If you've got the RSI holding in the upper half of that band, so above 50, between 50 and 100, that's generally associated with a rising trend. And if it's in the lower half between 0 and 50, that's often associated with a declining trend or a downtrend. So I find that that's just a little bit of an assistant in terms of confirmation of rising trend or downward trend. I guess it's like a secondary or tertiary indicator that I'd look at. I won't make trading decisions based just off an RSI. It's one of those things that I'd look for additional confirmation that the trade I'm seeing is valid, but it's not. I won't base a trade purely on an RSI. That answers the question. Okay, then Mel Smith, you've asked, apart from time stops, when do you give up on a trade which is short of a target? Do you use a trailing stop loss, and where would you place it? So yeah, so another good question. I mean, what I find is quite helpful on daily charts is to use a 15-day exponential moving average, EMA. That I have found allows me to stay in strong trending moves, but it also gets me out if the trending move is starting to fail. And it's tight enough that you can often get out with most of your profit intact. So that's a trailing stop loss that I use. And Mel, also, I think what you'll find interesting is the box trading method that I talk about in the last session of this 5-part webinar series, where part of that process is actually looking at a time stop loss, where you either time stop a trade out or you use a particular point in time to reassess and decide whether you're still going to hold on to the trade or not. So make sure to tune in for that webinar at the end when it happens. And then last question, because we are running out of time, but it's actually the last question anyway, is Dave, you do important macro events or announcements influence your decisions when it comes to trading? Yeah, yes, they definitely do. You say, let's say you've identified a clear chart pattern with a high probability of a breakout, but the FOMC is in the same week. Would you still take the trade or not? I will invariably, but sometimes I am cautious to actually hold it over the FOMC announcement, depending. Or I might tighten up a stop loss. Or, again, it's one of these things. There's never any total certainty in trading. There's a little bit of an art to it. It's a funny game. It's a mixture between art and science and maths and all of these things that come together. And there's a little bit of gut feel and a little bit of intuition that also needs to be applied as well. So yes, sometimes I'll back out before an FOMC decision, but sometimes, counter to that, I'll actually, go in with a view. And like today, this US CPI number came out. I kind of built a scenario where I felt it was probably going to come out slightly below market expectations, and the market would rally on that. And I put a long position on the S&P 500 with a very tight stop loss, and it worked. So, sometimes around economic announcements, you do need to be careful, because there's no question there's a lot more volatility around economic announcements. But I mean, your question is, will I still do a trade? Yes, I often will, but I treat each trade, independently. So depending on the circumstances each time. All right. It's 4:30 my time, which makes it 6:30 for you in South Africa. That's the end of the hour. So I'm going to wrap it up there. It's been great to be with all of you again this week. Next week, we've got another one of these. We'll be looking at risk management and money management for next week's webinar. And it'll be next Thursday, same time, same place. So I look forward to seeing you then. Take care, and thanks everybody for tuning in. Bye.